Hello and welcome. We're about to tackle a really crucial topic for any UK landlord, the huge changes to mortgage interest tax relief. To make sure we get this right, we've teamed up with the experts over at My Tax Accountant to put this whole analysis together so we can finally make sense of what these complicated rules actually mean for your bottom line.
So, let me ask you something, right off the bat. Is it possible that your rental property, the nest egg you're counting on, is actually secretly losing you money right now without you even knowing it? The answer? Well, it might just shock you.
To really see how this is possible, let's talk about someone we'll call Sarah. Sarah's a freelance designer living in London. A few years back, she bought a buy-to-let flat, thinking it was her golden nest egg for the future. And for a while, it was perfect. And then, the tax rules got turned completely upside down.
Okay, so to get our heads around just how big a deal these new rules are, we kind of have to turn back the clock a little bit. Let's take a quick look at how landlords like Sarah used to figure out their profits, back in the good old days.
Now, have a look at this. The old way of doing things was honestly refreshingly simple. Sarah's rental income was just over 10 grand. From that, she could deduct her running costs and, this is the crucial part, she could deduct all of her mortgage interest. That left her with a small but real pre-tax profit of 353 quid. As a higher rate taxpayer, she paid her 40% tax on that, and she was still left with a post-tax profit of £212. It wasn't a fortune, but she was in the black. It made sense.
But then, everything changed. A piece of legislation called Section 24 came along, and it threw a massive spanner in the works for individual landlords absolutely everywhere. Its impact has been nothing short of a revolution in the rental market.
So what on earth is Section 24? Well, in a nutshell, it means you, as a landlord, can't just subtract your mortgage interest from your rental income as a normal business cost anymore. Instead, you get a tax credit worth 20% of your interest payments. And here's the real kicker. That 20% credit is flat. It's the same whether you're a basic rate taxpayer or a higher rate one. And that one little change, it messes up everything.
Now, this didn't just happen overnight. The government kind of eased it in, rolling out the changes over 4 years, starting way back in 2017. As you can see, the amount you could deduct dropped every single year. And now, for the 2025-26 tax year, we are fully in the new system. 0% is deductible. 100% of your mortgage interest now falls under this new tax credit rule. All right, stay with me here, because this is where the numbers get, well, a little bit crazy. Let's go back to Sarah's flat and run the numbers again using these new rules. I think you're going to be pretty surprised by what you see.
So, before we dive into the new calculation, let's just be crystal clear on the big picture difference. The old way? Simple. Mortgage interest was a business expense. It reduced your profit before you paid tax. The new way? It is not a business expense. This means you get taxed on a much, much higher income figure, and you only get that small credit back at the very end of the calculation.
Let's break it down step by step. We start with Sarah's same rental income and the same operating costs. But, hang on a minute, look what's missing. The entire mortgage interest payment of over £7,000 is just gone from this step, and that one change inflates her taxable income from a few hundred quid to a whopping £7,587.
£7,587. Let that number sink in. This is what HMRC now says is Sarah's taxable income, her profit, even though almost all of that cash went straight out the door to her mortgage lender. For a higher rate taxpayer like Sarah, this is a financial disaster. And that's not all. This can actually push some people who were basic rate taxpayers into the higher rate bracket, just because their income on paper suddenly looks so much bigger.
Okay, so now for the rest of the maths. First, the tax is calculated on that massively inflated income figure. For Sarah, at 40%, that's a tax bill of £3,035. That's a huge jump from the £141 she used to pay. Then we apply that little tax credit we talked about, 20% of her mortgage interest. That gives her £1,446 back, but when you subtract that credit from the tax bill, she's still left with a final painful tax bill of £1,589.
And here it is, the knockout punch. This chart says it all. Sarah's small but very real profit of £212, it's completely gone. In its place, she is now looking at an annual loss of £1,236. And let's be absolutely clear, nothing else changed. Her rent is the same, her mortgage is the same, her costs are the same. This one tax change single-handedly turned her investment into a money pit.
And look, this isn't just some hypothetical story about Sarah.
This is the reality playing out for individual landlords all over the United Kingdom. This tax change has put a massive, systematic strain on the entire rental market.
Don't just take my word for it. This quote from a report by the Intermediary Mortgage Lenders Association sums it up perfectly. Some higher-rate buy-to-let investors face tax rates of over 100%. It sounds completely bonkers, doesn't it? But as we just saw with Sarah's real numbers, it's the harsh truth. Her tax bill was more than 4 times her actual cash profit. And if you're sitting there thinking, oh, well, that's just a London problem with its high prices, think again. Have a look at this. Even in the Northeast, which has some of the best rental yields in the entire country, a higher rate landlord goes from a healthy profit of £451 to a loss of £306. It is the exact same story no matter where you look.
Right. Time for a quick pro tip, because this is a question that comes up all the time. It's really important to note that these rules only apply to properties owned in your personal name. If you own properties through a limited company, you can still deduct all of your mortgage interest as a full business expense. But, and trust me, this is a very big but, moving your properties into a company is not a magic bullet. It comes with its own very serious tax and legal hurdles, like stamp duty and capital gains tax. You really have to know what you're doing.
So, with all of this going on, you're probably sitting there thinking, okay, this is pretty bleak. What on earth can I actually do about this? How can you protect your investment from these disappearing profits and, frankly, insane tax bills?
Well, the good news is you're not stuck. You're not helpless. There are definitely options on the table. There are steps you can take, but every single one of them starts with a clear, honest look at your own personal situation.
So here's your game plan, your path forward. First, you need to do a full MOT on your entire portfolio. Run these new numbers for every single property you own to find out its true profitability. Second, you have to know your personal tax bracket inside and out. It is the single most critical piece of this whole puzzle. Third, start exploring your strategic options. Could incorporating work for you? Are there better mortgage deals out there? And finally, and this is the most important one, get professional, personalized advice. This is way too important to rely on something you read on a forum.
And that, of course, is where My Tax Accountant comes in. Navigating these unbelievably complex rules really does require specialist knowledge. They have the expertise to help you understand all the different implications and build a tax-efficient strategy that actually works for you and your property business. Honestly, if anything we've talked about today has made you feel a bit worried, the absolute best thing you can do is just talk to a professional. The team at My Tax Accountant can give you expert, tailored advice on your specific situation. You can reach them on 020-8570-8531, or you can drop them an email at info@mytaxaccountant.co.uk. Okay, and before we wrap up, just the important legal bit. Please remember, the information in this presentation is for general guidance only. It is not financial advice. Tax laws are incredibly complicated, and believe me, they can change. So before you make any big financial decisions, you absolutely must consult with a qualified professional like the experts at My Tax Accountant.
We really hope this breakdown has helped clear things up for you. If you found it useful, do us a huge favor and hit that subscribe button. We'll be back with more clear, straightforward guides on tax and finance. Thanks so much for watching.